Hello everyone, welcome back to another video. I hope you're having a great day. And today we're going to be talking about the lesson 6 video for unit 1, the bid, ask, and spread. Generally speaking, when people think of a stock price, they think that there's just one number, right? And in a trading platform, you normally see two prices. There's the bid, which represents the buyers, and then there's the ask, which represents the people selling. The small gap between those two numbers is something called the spread. It may be only a few cents, but it severely affects every trade you make, especially larger orders. And in this lesson, we're going to be talking about that. Let's go on to the next lesson. So every stock has two prices. Let's make an example here. Let's suppose a stock has a bid of $49.98 and an ask of $50.02. So the spread would be 4 cents. And 2 cents is so minimal, but it's extremely effective and extremely important, and we'll cover it later in this video. So the main question is, why is a stock both $49.98 and also $50.02 at the exact same time? These numbers come from two different groups, which is the bid and the ask, as you can see on the screen. The bid comes from the people wanting to buy, the best buyer in the market. You want to buy for cheap, which is on the lower end. And then the ask comes from the cheapest seller, the lowest price a seller is willing to accept. Right? You want to sell expensive and you want to buy cheap, sell high. Easy as that, right? You make money. That's what you want to do. You never want to buy at the bid. So the bid is the highest price a buyer is willing to pay, and the ask is the lowest price a seller is willing to sell for. They're basically buyers are for one amount and sellers asking for another. So let's look at the bid more closely. The bid is the highest price a buyer is currently willing to pay. In our example, the bid is $49.98. That means someone in the market is willing to buy the stock for that price right now. The important part is what happens when you sell. If you place a market sell order, you're telling your broker to immediately sell at the best available price. You would normally sell to the highest bidder. So in that case, you would receive about $49.98 per share. So the key idea is if you want to sell something as quick as possible, there's no way you're going to be able to sell it for more expensive because no one's going to be want to buying it for more expensive. So instead, you would sell it to the highest bidder, usually more closer to the bid or even at the bid, which is pretty important to understand as well. Let's go ahead and look at the ask. The ask is the other side of the quote. It is the lowest price a seller is currently willing to accept. In our example, the ask is $50.02. That means the cheapest available seller wants to fit $50.02 per share. If you place a market buy order, you will usually pay the ask because you're asking to purchase immediately. So the exact opposite. So you want to buy something as quick as possible. So chances are you're not going to be able to buy it for cheap because no one's going to be able to sell it for cheap. So you're just going to go to the cheapest seller, usually more closer to the ask or at the ask. So there's a pretty easy rule. You buy at the ask and you sell at the bid, right? You don't want to do that, but when you place a market order, you immediately want to buy or sell something, that's just what's going to happen. The ask is above the bid because buyers want to pay less while sellers want to receive more. When those two sides finally agree to a price, when an investor who's buying and an investor who's selling agree to a price, that's when a trade happens. Now let's look at the spread. Now we can calculate the spread. The formula is just the ask minus the bid. It's that easy. So our ask is $50.02. Our bid is $49.98. Those two minus here, I'm not going to repeat them again because they're long words, give us 4 cents. So the stock has a 4-cent spread. They may not sound important because it's just 4 cents. I mean, come on, 4 cents. What's the big deal? But the spread is one of the easiest costs in trading to overlook. Your broker might advertise a $0 commission, but that does not mean every trade is completely free. You may still lose money by crossing between the bid and the ask. So let's go ahead and look at how the spread can be actually a cost. Imagine that you buy one share at the ask for $50.02, right? Because you're just immediately buying it, so you're going to buy at the ask because you want someone to sell it for you quickly. 1 second later, you change your mind and you say, you know what? I changed my mind. I'm going to sell it. So you sell at the bid and receive $49.98. You paid $50.02 for the ask and sold it for $49.98 at the bid. So you lost 4 cents and the stock didn't even move. That loss came entirely from the spread. You bought at the higher side of the quote and sold on the lower side. You bought at the bid, you bought at the ask and sold at the bid. That is why the spread is a real trading cost. And the reason why it's such a big issue is because it grows tremendously with trading size. 4 cents on one share is almost nothing, but the cost grows extremely quickly as the order gets larger. The quick formula is the spread multiplied by the number of shares. Suppose the spread is 4 cents, like our example, and you trade 100 shares. 4 cents multiplied by 100 equals $4. So if you buy those 100 shares and immediately sell them, the spread costs you about $4. Now, two examples. Imagine doing that repeatedly throughout the day, or imagining trading a stock with a spread of 40 cents instead of 4 cents. These costs can add up very quickly, especially for institutional investors and people who are investing large amounts of money. In this example, we only have 100 shares. But what if we have 1,000 shares? This turns to $40. Then 400, 4,000, 40,000, 400,000. When you're placing millions of shares, even a 4 cent spread, which isn't that big, can become a serious issue. And imagine what it would be if it was 40 cents. This is why active traders pay extremely close attention to spreads, especially in stocks that do not trade often, meaning that the bid and the ask, the spread will be larger. The spread also gives us a hint about liquidity. Liquidity means how easily you can buy or sell something without causing a large change in its price. A heavily traded stock usually has many buyers and sellers competing with one another. That competition tends to push the bid and ask closer together. So a narrower spread usually means the asset is liquid and relatively cheap to trade. A wide spread often means there are fewer buyers and sellers. That can make an asset harder and more expensive to trade. For example, a larger company, like Nvidia, might have a spread of 1 cent. A small company that barely trades and has minimal volume on all the trades, can have a spread of 20, 30, or even 40 cents. So even if both stocks share the same share price, the one with a tighter spread is normally cheaper to enter and exit. Now let's go ahead and look at something else called the midpoint. Sometimes a platform will show something called the midpoint. I know some brokers do this. I know Interactive Brokers does it. But the midpoint is just the average of the bid and the ask. That's it. So in our example, we have the bid at $49.98 and $52.02 for the ask. So we can add these two together and divide by 2, and that gives us exactly $50. But there's something to understand here. The midpoint is just a reference. The best buyer is still offering $49.98. The cheapest seller is still asking for $50.02. There may not be anyone willing to trade with you at exactly $50. The midpoint just gives us a helpful estimate of where the stock is trading, but it is not always a price you can actually receive. Now let's talk about market makers. So we did talk a little bit about market makers in some past lessons, but in this one I'm going to try to explain it a little more thoroughly. And also, market makers are pretty influential in markets and are also important. So we'll go down later on in line unit 1. But this is just another overview of market makers. So on both sides of the quote, both sides of the bid and ask, usually a market maker is standing there. A market maker regularly offers to buy from investors at the bid and sell to investors at the ask. That allows people to trade without waiting for another investor with the exact opposite order. That makes it easy. They provide liquidity because they're offering to buy at the bid and sell at the ask. So if you want to sell or buy, a market maker is ready for you. They got orders lined up, which is easy. But market makers take on risk by doing this. It might buy shares from you and then see the price fall before it can sell the shares to someone else. It also has to manage its own inventory and react when prices change quickly. The spread helps compensate the market maker for taking those risks and providing liquidity. So, generally speaking, the spread is not just some random fee. It is part of the cost of having someone ready to trade when you want to buy or sell. So, let's go ahead and go on our final slide, the big takeaway, as the past 5 lessons. So let's finish with some main ideas. A stock quote has 2 sides: the bid, which is the highest price a buyer is willing to pay, and the ask, which is the lowest price the seller is willing to accept. You normally buy at the ask and sell at the bid when placing something called market orders, which is just an order that you want to get filled immediately. The spread is the difference between those 2 prices, and it creates a real cost even when the stock itself doesn't even move. A narrower spread usually signals higher liquidity and cheaper trading because the spread is smaller, thus you have less spread costs. A wide spread usually means trading is a lot more expensive. and thus you would have more expensive trading costs. And the midpoint is just a reference between the two prices. It's not usually a price you can ever trade at. So that is this lesson. I hope you enjoyed it, some learned something new. Go ahead and finish this lesson, and I'll see you in the next one. Bye bye.